It is great to be here with everybody. So I'm David Azarkoff. I'm the Senior Equity Strategist at JP Morgan. And today I'm joined by the C-suite of South Africa's buy side. So it is a real honor for me. It's also a bit of a change because normally asset managers ask me questions, and now's my chance to get a little bit of revenge. So I get to grill them a little bit. So why don't we just kick it off, and first question, we'll just start down the line with Cherie. Markets are very quickly moving to 24-hour trading, not so much for single stocks quite yet, but definitely for FX, for bonds, for indices. How do you guys manage this as an organization in terms of staffing trading desks? How do you grapple with the changes of needing people to be on 24/7, but also needing to be like thoughtful and stuff in spite of the schedule? So what do you think?
Thanks, David. Morning, everyone. Nice to be here today. I think for South African fund managers or traders, we're in the lucky position to be in SA. So we basically catch the close of Asia. We get most of Europe, and we get the open of the US. So you're kind of in that liquidity window, and you get the best of all the worlds. But I can understand I guess the desire in the FX and futures markets in particular to be always on, but it's not really a question of being always on. It's about whether there's enough liquidity in the market during those times. So if there's no change, if risk capital is there and there's enough participants and that's dense, then of course it would work. But if that's not there, then there's no point. Then you're just facilitating access. So in FX markets and futures, for sure, especially in the time of geopolitical uncertainty, I can understand, but liquidity still has to be the main driver.
Anne, what do you think?
So I mean, I think as a global business, hi everybody. As a global business, we do have the advantage of having dealing desks kind of across the world, so we're always on. But I think importantly, as a buy side, our strategy is never really one of kind of wanting to be on all the time. We kind of like the break when the market closes, and I think that buy-side managers are not into kind of the constant trading in and out. So while it's great from an efficiency perspective, it's not something that I think enhances our ability to do what we do as buy-side managers.
Fatima?
Yeah, very quickly. I mean, most of our clients are long-term investors, so having our portfolio managers making decisions at 3 a.m. is not really relevant. So, what we're more concerned is about proper risk management, robust systems, good compliance, governance, stock picking ability, execution efficiently, cost management, etc. So for long-term investor, 24-hour trading is really just irrelevant.
Okay, good. Shifting gears, and I'll start at the other end and we'll work our way back. The sell side is consolidating, both fewer bigger banks, but also more smaller players who are really strong in their respective niches and not trying to be all things to all people. First, Fatima, do you think that's the right way to frame it? And how do you see the consolidation and the fragmentation working simultaneously?
Okay, I can really speak about the asset management industry, even though in the post-1994 period, we had a lot of international banks who came into South Africa, and over the last couple of years, we've just seen them dwindle. So then again, the dominance of the local players took force. In the asset management industry, we've seen this wonderful evolution take place over the past 20 years. And my background is I was a stockbroker. 28 years ago, sat on a trading desk. So it's also wonderful to be here today to see the evolution of the trading industry and how systems and technology and innovation is changing the landscape so much. But when I entered the industry, there were very few small players in the market. In fact, there were no small players in the market. We changed that. We changed that as an industry. We engaged the regulator, we engaged market participants, we engaged exchanges, we engaged asset owners. And, coming to 2026, we've got this huge number of asset managers that now exist, from very small to mid-tier asset managers managing products across asset classes, private markets, public markets, local, global, income, equity, all the different products. And what's really fantastic for the consumer is that you're getting innovation, you're getting increased competition, you're getting lower barriers to entry, you're lowering the costs of products and services, and it keeps everyone on their toes. So I think having, not preventing, and I think the regulator was very supportive, particularly coming out of an apartheid era, to ensure the facilitation of inclusion of Black people, women in the industry, and they've done that very, very well. But also we saw and that was as a result of a change in the regulatory environment as well. So we just got to make sure that disruption, providing better services to the end user, is not compromised as a result of the big players in the market wanting to dominate where the regulations are going, because then you kick out the opportunity of innovation, lowering costs, adding value to the end user.
Anne, what do you think?
I think we're seeing consolidation across both buy side and sell side. And in principle, there's nothing wrong with the idea, but one needs to understand the reasons behind the consolidation or the fragmentation. And obviously, we are finding ourselves in a situation, if I use South Africa, the pie is not getting any bigger, right? So the only way for businesses to continue to grow is for businesses to come together. But what then loses out in that process, right? I think there's less jobs to go around. As buyers of the services that are provided by the sell side, we find that in terms of research, as an example, we are seeing a lot less offering of kind of niche, mid, small cap type research coverage, because everybody in consolidation, everybody is kind of offering you top 20, top 40 share research coverage. So there is some sort of limitation in terms of what it is we can source from that market. But I do think that in a shrinking economy, in a space where we have got some real employment and unemployment issues in this country, it's not ideal, because we are just seeing that the bigger players are the only ones that are able to survive. If I talk asset management in particular, the increase in asset managers in the market that Fatima spoke about hasn't necessarily led to a bigger pie again, right? So we are struggling to get small asset managers to kind of a scalable size that they are able to say, actually, without the need for consolidation, we can continue and we can sustain and we can scale. So the answer really is we need to find ourselves in an economy where there is growth, and then this never needs to come up as a conversation.
Cherie, what do you think?
Yeah, I think to add on to what Anne says around why it's happening, I think on the consolidation side, for the big banks in particular, there's a question of regulation and cost of capital. That's probably led to kind of big banks fleeing smaller markets in particular. And then on the fragmentation side, I think that's a function of how the market has evolved to unbundled research in particular, and in response to these high costs, finding their niche and differentiation. So I think the ecosystem and the market forces have kind of led to this, and I think it's been a natural response. I mean, but I think the question again goes back to the fact, do we want only two big banks with risk capital or balance sheet, and do we want many small players where there's not enough scale? Obviously not, because that won't facilitate a healthy ecosystem on the sell side, which is what we want to be able to thrive. So I think that for us is the challenge right now.
Okay. And let me just jump back to Anne. So you're one of the biggest purchasers of these kinds of services across SA. How are you allocating your business, and what sort of landscape do you want to see sort of going forward?
I mean, how we allocate, so we've had to kind of shift and start capping out what we do in terms of large research coverage or large stock coverage. And we are now almost like desperately having to go out to market to say who is able to provide what has now become non-mainstream. The challenge remains, however, that, you know, with a shrinking pie, it becomes very difficult. But we are finding that we're almost inundated with coverage that everybody can source for you. The problem is also, you know, in the small cap space, that space is not growing much either. But what we are doing is we are bringing in a lot more in-house resourcing for that. And we are also using a lot of machine learning in particularly the smaller space. We do have the ability, for example, to utilize a lot of our global research offerings as well, so that does help. But I do think that the consolidation has not been good for us as buyers of services.
And Fatima, what do you think? What sort of ecosystem of suppliers do you want to see over the coming years?
A diverse set of suppliers, and I think the capital markets is changing so much. I mean, we've now got actively managed ETFs on the JSE, we've got ETFs, we've got the private markets landscape. If you look at where the big asset owners are allocating, it's not all on the JSE, you know, so there's offshore, there's private markets, and that's where a lot of the interest is. If you look at what Rudy was saying with public-private partnerships, as well as blended finance opportunities, you know, we've got to see what other markets have done in that space. So if you look at the London Stock Exchange, for example, they've got this fantastic product that facilitates the investment of blended finance and public-private partnership investments and allows asset owners to come through those regulated vehicles. So the future of the capital markets in a growing economy such as South Africa is not this narrow market leadership that we see on the JSE. Money is going outside of that because there's just too few stocks, and you can't just play in the liquid counters all the time, and the same guys are doing the same thing over and over again. And you've got, I mean, I would just buy an ETF, I'm going to be quite honest with you, because most of the managers can't even outperform the index. So buy an ETF, or maybe a little bit of an actively managed ETF. I mean, this last year was, oh, well, we're not going to have narrow market leadership in the gold miners or da-da-da-da, because nobody outperformed the index, right?
Not only, like, there were a lot of people who significantly underperformed.
Yeah.
I've had some pretty difficult meetings here this week as I asked people, so how'd you do? And a lot of people said, well, did you see the results? And I have to pretend that, no, I didn't look.
So I'm just saying that money is going into lots of different places and not through the exchanges. And we've got to find a way to bring those two together.
So let me just follow up on that. This is the JSE Trade Connect conference. What can the exchange do more, differently, better to capture more of that investment flow through the exchange?
I think they've got to make it easier. I think there has been an effort to create this unlisted market segment and try and attract buyers to that segment and do private placements through that. But I do still think that everything is painful. Like, you know, to list an AM ETF, to get JSE approval took a year last year on one of our global AM ETFs. You know, so it's you got to take away the friction, man. The friction is painful.
Okay.
I mean, I think if I can add to that, you guys are clapping. This is a JSE event. But you know, I do agree that it's onerous to be listed, right? And when you are a small company, when you then start counting the cost of the process of listing and the process of remaining listed, that is part of the reason why we have so many challenges and companies saying, you know what, it's actually easier to rather delist. It costs us too much in audit, it costs us too much in governance, it costs us too much in reporting, and that's got to be a bit easier. I mean, maybe we tier the requirements for listing depending on size or whatever, but something's got to give, because I think the trend of delistings creates issues for us as asset managers. It creates issues for investors. So yeah, in a nicer way, I agree with Fatima.
I've done a few panels with Fatima, and everyone has involved somebody saying just that. I agree with her, but I just want to say it in a nicer way. But the one thing I also wanted to pick up on, I was in Riyadh in November, and we hosted a meeting with the CMA, the Capital Markets Authority, and local asset managers in Saudi. And one of the real complaints was the Tadawul, the stock exchange, has made it, and the CMA have made it difficult to move from the sort of junior listing to the senior listing. And the asset managers are like, the only reason we have a junior market is we want the junior market guys to become senior market guys, and why are you making it difficult? And it's really interesting that South Africa really hasn't developed that junior-senior split, which I think is in some ways quite good, because then the flow is natural. But I do take your point that easier listing requirements for smaller companies makes a lot of sense. Anyway, Cherie, let me just...
Sorry, maybe I can just add my little point to that. I think globally the trend in constructing portfolios from, let's say, a wealth manager's perspective as an example, it's been a big trend to sort of employ the barbell effect, where people are now using ETFs to get their beta exposure, and they're using private markets and alternatives to get their alpha. And it's a lot more predictable, reliable. So markets in themselves are evolving because of what clients want. And I think that's also playing out in listed markets, and as Fatima said, private markets becoming a lot more popular.
Now, let me just ask you directly, if there's something, what do you think the exchange can do over the next few years to help you in your business? How should the market infrastructure outside of the exchange evolve?
Yeah. I think modernizing infrastructure is one thing, so getting rid of the post-trade friction costs, that's for me is a big thing. In our business in particular, we're looking at tokenization, and we're thinking about what the future is going to look like. And there you want sort of atomic DVP, so you want the asset and the cash to settle instantaneously, frictionless. And we can't do that yet. If we did that, there would be capital would be freed up, collateral wouldn't be an issue, there'd be instantaneous access, and it would facilitate trade so much easier. So that's one thing that we can do. But the other thing is that the regulations themselves have not caught up. So we've applied for a CASP license and had to go through the process with the FECA to explain how tokenization works. And I mean, it's been great to go through that, but it just dawned on me that the regulation themselves have not caught up. And I think globally, it's not as though atomic settlement happens already, but it's certainly in play in a business like JPM. There are many other examples where the markets are evolving to take that into account. So I think innovation in the JSE and updating the infrastructure is really critical for us to get ourselves into the next kind of trend of what's coming.
And do you have any other asks for sort of the market infrastructure over the next 5 years? What do you think really needs to be done?
I mean, we're always keen on innovation, but I also don't want us to kind of denigrate what is actually one of the most highly regarded financial markets in the world, right? So I think that we must give ourselves credit for that the JSE is really kind of world-class. We always want to see and be able to keep up with, if you look at kind of what's happening in Asia, like that is just, it's mind-blowing, and it's very like forward-thinking. And I think that maybe we do need to be a little bit more forward-thinking. I don't think it's an exchange issue. I think it's possibly, as Cherie's saying, I think regulation does need to kind of keep up. But it's positive when you see, for example, we're now out of grey listing, right? So it makes the ease of trading so much easier. I mean, if I just think about the process of opening accounts offshore when we were grey listed, it was, clients are like, actually, guys, leave it. Like, it's too much work. So I think that has really helped, and we want to see continued kind of intentional moves by policymakers and by Treasury to make it easier for us to kind of continue the global trade. But I actually think that we mustn't be too hard on ourselves. I think we have got a really good treasury market system in this country.
Okay. All right. Now, perennial debate, actives versus passives. It's very clear to me when I look across the global data, passives are continuing to gain market share. And what are you guys doing at M&G to push back against that trend?
I mean, there's no need to push back. I think that I would certainly encourage anybody who considers a balanced investment approach to make space for both passive and active. The only thing with passives that I think we don't often factor in, even if you take out kind of the lower cost of it, is you're almost guaranteeing yourself a sub-index return, right? Because you are buying the index, and then however small the cost, once you've minus that cost, that's kind of what you're locking in, right? So, I mean, I don't know how clever that is as a long-term strategy, 100%, but I certainly do believe that there is room for active and passive in the market. I think that the active-passive discussion is one that raises its head and then gets quiet depending on how strongly the market has performed. When you've got a resources index that's done over 100%, by God, everybody got a passive, right? But that is not a guaranteed kind of performance that one sees over the next few years. So I think you've got to make sure that you are well diversified in that regard. I think you've got to make sure that you understand the risks of going 100% passive, which is kind of locking in an index underperformance. Also from a risk management perspective, think about a passive strategy effectively says you buy high and you sell low, right? Just as it takes up more space, you buy more of it. I don't know, as an active manager, that's certainly not what we were taught in school. So I think that stick to what it is you know, but there is certainly space for both active and passive. There's no need for us to push back against passive. There is a need for us to continue to validate what we do as active managers in the market. Our fact sheets are very clear. We've stuck to what it is we do well, and we've done it well. So ultimately, I think that there's no need. It's not an either-or discussion.
Cherie, now we hear what is happening to slow this stuff down. What are you doing to push the accelerator on getting more people passive?
Yeah, I think the debate's moved beyond passive versus active. It's moved towards what do clients want. Clients want consistent outperformance, they want low costs, they want access, and they do want risk management, but you can achieve that with well, I've got a solution for passives, enhanced indexation. I mean, that's really what you can do. And now with actively managed ETFs, that's a great strategy. You can buy the index and you can port alpha onto that and you can list it. But again, it goes to the need of the client. And in the DFM space in particular, the DFMs use ETFs as a tool as building blocks to achieve what they want to get for the clients. And it's cheap, it's effective, it can be traded in and out quite fast, and it's quite accessible. So I think from that perspective, that also has an impact on kind of how ETFs have gained popularity. In SA, we obviously don't have the tax advantage, but we do have the kind of the global advantage that people get the global allocation in an ETF as well. So yeah, the debate in itself has moved beyond where we started. I think there's room for both, but you can't ignore the fact that costs are pretty low, and it's quite compelling to think about what you can do with an ETF just as a building block. And I think if you look at the different asset classes, yes, equities is quite easy. Fixed incomes are probably a bit more complicated, but we've listed an income ETF and it's doing quite well, especially in the personal share portfolio space, which is quite a big market in SA, I think about 1.5 trillion. And the fund managers, they use ETFs quite extensively. So yeah, that's kind of where the world is going as well.
Fatima?
Yeah, I think since we're having a discussion about market structure, I think the evolution of AM ETFs on the JSE is a very positive development. And over time, we may see the migration out of the collective investment schemes industry into that segment of the market. And I'll tell you why. Investors like low-cost products and investors like transparency. Investors like intraday trading as well, especially retail investors, right? So you can't get any of those three things from the collective investment schemes industry. You can't get a low-cost product because there's 10 layers of platform fees before you actually get to the end product. You've got the fund management fee, then you've got the platform fee, then you've got the broker fee, then you've got this fee, that fee. By the end of it, and it's so hard to actually navigate all of that as a retail investor. So for a retail investor, if we're talking financial inclusion and simplicity, why invest in a unit trust when you can just buy an AM ETF or an ETF on the JSE? So it makes total sense, right? And you're getting full transparency, not delayed transparency over a quarterly basis, and you have the ability to trade intraday. So I love the idea. I think they're going to become commoditized. I think any simple equity fund, balanced, multi-asset class, listed, income, money market, etc., there's no reason to have a unit trust anymore. They all will migrate to the JSE, which will improve liquidity for the JSE. There'll be more listings, etc., etc., etc. The non-commoditized solutions may still stay in that CIS industry. There's 4 trillion rand sitting there. So if 4 trillion rands can move, at least 3 trillion rands could move into a space that is much more efficient. If we're talking market structure, why not? Why do South Africans list their global portfolios in Ireland, in Luxembourg, in all of these places? When you can do it here, and there's South African investors investing, and then you put on an additional cost of getting Section 65 approval for a feeder fund, and so it's cost, and the ecosystem is moving away from South Africa to the offshore market. Keep it here. Bring the costs down, do it more efficiently, create easy market access, and I think it will improve structure and depth and all the nice things we're looking for.
And do you think this can happen both on the equity side as well as the bond side and the global side?
Absolutely. It's already, I mean, if you see all the listings that have taken place, they're across the board.
Okay.
Yeah, since the emergence of listings of actively managed ETFs. And you've seen that globally as well, right? So we're beginning to play catch-up to the US markets because you've seen this rapid rise of AM ETFs in the US markets. And we're beginning to see that now. Every day, fund managers are migrating out of the CIS environment into the AM ETF environment. And really, it does make sense to the retail investor, to everyone, because you just, that benefit of a cost reduction, the transparency, the governance, all of those nice bells and whistles, I'm for it.
Okay. All right. Let's switch gears and just talk about the offshore allowance. When I was a kid and I started covering South Africa, it was 20, then it went to 30, and now it's 45. Cherie, what do you think's been the impact of that shift from 30 to 45 in the last few years?
There's a few points I can make around that. So the one thing is been good for South African long-term savers. I mean, there's no doubt about it. The South African market in itself was quite concentrated, didn't have economic growth really. So to be able to diversify clients' portfolio and have the freedom to do that, I think that's been really good. And I think it's also for South African investment managers to up our game. So we were quite insular before. Now we're competing with the likes of BlackRock. I mean, a business like Prescient obviously has to do quite a bit to be seen to be able to manage money globally, and it's a good challenge for us if you think about where the world is going. So I think it's been good on balance, and it doesn't mean that the South African markets in themselves have disappeared or faded. I mean, it's still thriving, it's still doing really well, and I think it's just kind of enhanced the opportunity set for savers.
Anne, what do you think?
Yeah, I mean, the move to 45%, I suppose, on our side, on the buy side, had kind of two schools of thought, where some kind of went, as soon as it opened, fully 45%, right? And then others like ourselves took a somewhat more measured approach. I think that trade of going fully offshore has been a very costly trade, obviously, given what our markets did. But at the same time, I think that the offshore-onshore discussion is somewhat unfortunate for SA liquidity, but at the same time, it's also important to remember that a lot of investors who invest in these portfolios sit with South African retirement liability, right? And you've got to try and make sure that in the actuarial world where all the clever people reside, in matching those liabilities, sometimes it's not a very clever thing to do to go kind of fully offshore. I do think that the opening of the allowance has also opened up our capital markets to offshore investment, and I think that that's something that we can't just look at the negatives. I think that what our industry needs to do is kind of go tell the global market that we are around, we are open for business. It's amazing how many Western investors very rarely think of us when they're thinking about like listings and things like that. So I think it is still an opportunity, but unfortunately it has kind of limited the space in SA. But those of us who didn't go fully offshore, I think, benefited over the past few years. None of us saw, at least we didn't see the currency going to where it is at the moment. But at the same time, I think one has to be very cognizant of the rand-based liabilities that many, many South Africans sit with.
Fatima, what do you think?
So two things. So positive and negative. From a positive perspective, all the offshore allocations, that majority of the offshore allocations being made by South African asset owners and investors was allocated to global fund managers. And so very little, pockets of skill existed in the South African asset management industry. Now everyone has a global fund. So that's been fantastic. So we've had a lot of global funds emerged out of South African asset managers, and you've got asset owners saying, oh, well, I've got a South African asset manager that can manage a global portfolio. Why give it to an offshore fund manager? So from that perspective, skills development, growth of domestic asset managers managing global mandates, yay. The second issue that I think I believe, and maybe this is a rumor, but that 45% was a mistake by someone at National Treasury, right? And then it was announced in the budget speech, and boom, we were stuck with it, right? So I think what they didn't think about was the impact on the ecosystem. So the impact on the ecosystem is the local broker network, the local, settlement, the administrators, especially in an environment where you're desperately trying to create jobs and generate economic growth. And suddenly you make this and it impacts that ecosystem of job creation and which did impact quite a few businesses, smaller businesses, administrators, custodians, et cetera, et cetera, et cetera. So that was not a great move on for that component. But from an asset allocation perspective, it's been good. It's been really good in an environment when you don't have, when you're chasing this narrow leadership of stocks on the JSE. So you want diversification, and you were able to source diversification as a result. Otherwise, you were stuck with 60 counters or whatever it is.
Okay.
I still really vouch for the proofreaders of the minister's speech, so I doubt it was a mistake. But, I think we've got some very clever people at the Treasury, and I understand the merits of it, but I do think that there was kind of possibly a lack of cognizance of some of the unintended consequences of the move.
Yeah, I remember reading I guess it was the budget statement. This was Feb 23 it came out? Was it Feb 22?
True.
And I read it, and I was like, wait, does that mean? And then I read it again, and I was like, they can't be doing that, really. And then I guess it was sort of the following, Tuesday, the budget was a Thursday, and then the following Tuesday, the SARB came out and was like, yeah, that's what it is. So I
just on the market structure again, right? We can only have everything rand denominated locally. And I've always wondered, and maybe we need to have a discussion with the regulator, why can't you do dollar denominated in South Africa? And again, this issue of why we spend so much money on listing instruments in Dublin and Luxembourg and all these other places, when we can do it here and not have these feeder funds and all these things that just add cost. So market structure, we really need to think about this 45% properly and what other vehicles that we use.
No, 100% agree. The other thing that I've noticed, some of you who know me know that most of my shtick is I'm the oldest guy in the room and I've done this forever. But I think if I've learned one thing about emerging stock markets is that market valuations are mostly a function of how much is locally owned. And where you find high degrees of local ownership, you find much higher valuations than stock markets where local ownership is lower. And to me, the big negative of moving from 30 to 45 was it certainly reduced the local investors who buy, maybe not the top 40, but the sort of small and mid caps, and getting that money moving out of the market to me was a real blow to the mid caps and the smaller companies that would be thinking about listing. But
I think subsequent to the implementation, the IMF came via CISA, I think it was hosted, to have a discussion around what's next. I think Treasury employed them to get sense from the asset managers. And the feedback or our questions to them was how do the others do it globally in other countries? And it's normally a stepwise change. So you get told it's going to be 45 in 5 years' time, and we'll move towards that systematically. But we didn't get that warning. So I think
you guys got a good couple of days warning. Can't shuffle all the assets around in 20 minutes.
So I think that, and then I think just in terms of kind of the global limits, and we tried to get an assessment of that. Didn't sound like there would be much more, but who knows? Someone could change it in future. Yeah.
All right. So we've heard about everybody moved stuff offshore, and then if you look at the last year, hasn't been a great call. So I guess maybe starting with Fatima, how have investors been navigating around the stronger rand and the big performance of the top 40 in the last 12 months?
So again, long-term investors, 12-month of performance is irrelevant. Of course, people were happy and excited, and the mood generally is better in the country for a whole lot of reasons. Operation Vulindlela, the getting off the grey listing, and then you see this rally in the gold price and better tax intakes and improves the surplus and the deficit and all of these positive things. So sentiment's positive, and that does create a positive cycle. So it breeds positivity, but we need to see SA Inc. Revalue so that we can, because I mean, you know, I think this gold rally has resulted in better tax coming through this, the SARS, etc. But we still got these issues. We've still got big issues as South Africa, and those need to be fixed. The water issue is not going away. There's a lot of, you know, we've sorted out the energy issue, but unemployment, policy certainty, the GNU is fragile. There are a lot of issues. But we're definitely on a better trajectory than we were 18 months ago. But again, short term, as long-term investors, we don't look at performance over 12 months.
Have you seen more of your underlying clients move money offshore as a way of sort of taking profits and taking advantage of the stronger rand, or have you seen them add more to the rising SA assets, to the rising SA stock market?
Yeah, so we've got to bear in mind that the stock market is not a reflection of the whole economy. And the projects that Rudy spoke about are not currently in the stock market. Some of it is government-listed and infrastructure bond a couple of weeks ago, which was hugely successful. But the excitement around the infrastructure spend will feed into the JSE eventually. But we have thousands of companies that exist outside of the JSE. And where we're seeing the most excitement and appetite on where money is flowing, private credit. Because banks have got to sit with huge amounts of Basel regulations and capital on their balance sheet, etc. They only want to focus on deposits. They don't want to give out loans. So we've got the emergence of private credit. We've got the emergence of the township economy. We've got the emergence of all these other areas of growth, venture capital, private equity, infrastructure, blended finance. That's where the excitement is. That's where all the money is going to at the moment. And so how we can, again, I take it to how do you bridge that gap between the listed, the public markets, and the private markets?
Anne, what do you think? What have your clients been doing?
Yeah, I mean, if I go back to the SA trade question, it's also important to remember that oftentimes the SA trade decision has actually got very little to do with South Africa and more to do with what's happening offshore, right? So if we look at...
As a proud American, I'm happy to sponsor the stronger rand.
Yes. So you know, yeah, I mean, I think the US... One must be careful. My visa's expired and I need to go apply for a new visa. So I need to be careful how I put this. But it's more the trade away from the West that has also really benefited us. So the rebalance is, once again, not necessarily just about the SA fundamentals and more about, well, nobody wants to go to that other country at the moment, right? So... Guys, I said my visa's expired. I still need to go apply. But nonetheless, I think emerging markets in South Africa, in particular in the emerging market basket, has benefited as a result of that. So even the then global asset allocation discussion on are you pro-EM or DM, it actually remains mainly a loud DM conversation, which then EMs have benefited from.
Totally agree. All right. We are down to a very small amount of time as the yellow panel is flashing. Let me start with Sharif. We're going to whip around quickly. Looking ahead to 2030, what should South Africa's capital markets look like?
I think stronger liquidity, more access, more participants, better cost structure. We still need strong balance sheets at the end of the day. And I think the role of the JSE to kind of be the custodian of that and to continue to build trust. And I think just kind of modernizing the infrastructure so that we can kind of play in the new spaces that's coming in the future. I think that's quite important for us.
Anne, what do you think?
I think that South Africa's needs are great, and we need to make it easy to be able to invest in our country. So the infrastructure conversation, we've got to create vehicles that make it easy to invest in infrastructure. So you need to be able to fix for the liquidity. You need to be able to make private market more accessible. You need to increase trust in the market. I think that our capital markets are very heavily influenced by kind of a lack of trust in the policymakers. So I think we've got to bring transparency out. We've got to bring costs out. We've got to just make it easier to kind of grow this economy.
Fatima?
Yeah, I think more financial inclusion, because you can have a very sexy JSE with great technology and infrastructure, but if 90% of the people are unemployed and you've got social unrest, it's not going to matter, right? So we've got to deal with access, market penetration, deepen the participation base, and then, of course, bridging this gap between public and private markets.
Okay. All right. Well, now is my chance to thank all three of you for your participation and thank everybody for sticking around for this. And I think it is now time for the next panel.
Yeah.
Thanks, David.